Hello and welcome back to the DGI Crab. So I've got a fun one for you today, kind of interesting for all of you immediate income seekers out there. So this video primarily is going to be for the bit of the older crowd, folks in their 50s who are starting to near retirement age and they don't have as much time. You don't have as much time to buy that low yield, high growth stuff like your Microsofts, your Visas, even the S&P 500 for that matter, because you're wanting to live off of your dividend income. Hopefully you've already got some things in your portfolio that are higher growth that you can continue to just sit on and compound. But now you're at a point where you are wanting to add some immediate dividend yield with your income so you can reach the goal of financial freedom and living off of those dividends faster. So for those tier 4 investors that are following the channel, I've only got 10 individual stocks in that group that met the criteria for me for high yield, fairly consistent year over year growth, even though it's a little lower growth. But what do we do as far as the ETF category goes? So I wanted to sort of extrapolate on this a little bit. I have another ETF video that covers this a little bit, but let's talk about some of the ETF choices that you may have in order to get this immediate high yield. So the first thing I want to talk about is I want to stay stock centric, dividend centric. There's a couple of funds here that are higher yielding that are for stocks, for dividend paying stocks, that I do like quite a bit for the people looking to add income now. So there is SPYD, which has a very simple, straightforward strategy and a low expense ratio. SPYD simply holds the 80 highest yielding stocks in the S&P 500. And then it'll rebalance each year, and some stocks will get the boot, other stocks will get added, but it is equally weighted, meaning that each of the 80 stocks have about the same amount of capital in them. So it's not like the S&P 500 where the weighting is a little heavy, where Microsoft and Apple make up a big percentage of that, and then companies 499, 500 have a smaller percentage. This is just going to be equally weighted across the board. You can see here, looking at it, SPYD has a nice starting yield, typically, usually in the 5, sometimes in the 6%, sometimes down in the 4s, like you'll see in 2021, where the stock market had a really hot year. The yield even on SPYD was down a bit, just down in the low 4s, but very, very nice starting yield typically. You're going to get some pretty good real estate exposure with SPYD, which I do kind of like because those real estate stocks are usually high yielders, and I usually don't recommend people are focusing in on real estate stocks in their younger years because the income is not tax advantaged like it is with a lot of other stocks. But this is a good option, I believe. And then there's also your DHS, which in my opinion is a very underrated ETF. It has the advantage of paying monthly dividend distributions. Doesn't yield quite as high starting out as SPYD, but it does have quite a few holdings in it, usually in the high 300s to low 400s. And again, it pays out monthly. And this one has a very low amount of real estate in it. So most of this ETF is going to be tax advantaged. Before we move on any further, I do just want to preface the rest of this by saying I'm not a licensed financial advisor, so these are just my opinions on what I think are some good ideas that you could take a look at, but always do your own due diligence when selecting any ETFs or individual stocks to invest in. So let's talk about some other things besides just your stock-centered ETFs. There are some interesting alternatives that current income seekers can go with in addition to stocks. So something you might look at is high yield bonds. So I'm a pretty big fan of SPHY, which has more than 1,900 individual bond holdings. So a ton of diversification among the high yield bond market. A very low expense ratio of just 0.05 Now, the share price growth as of today's recording, it's actually down about 8% overall since its inception in June of 2012. But with funds like this and some of the other ones we're going to look at here, share price growth isn't necessarily the overall goal. The high starting yield is. So with your high yield bonds in this fund, your starting yield is probably going to be anywhere from 6% to maybe as high as about 7.5%. It's actually getting up more towards like 8% right now. The high yield bond market seems to be just taking an absolute pounding right now. But really nice starting yield. SPHY pays monthly, and if you don't have any bond exposure by the time you get up into your 50s, not a terrible idea to start considering that a little bit as you want to add some additional diversification and predictability and safety to your portfolio. So another interesting ETF is PFFA, which holds preferred shares of stock. Now, preferred shares are a little bit different than your regular shares of stock. They are typically much higher yielding. They have a lot less price swings. They're not quite as volatile as your normal stocks. And I'm certainly not an expert on preferred shares or how to go about selecting and purchasing individual ones. Definitely don't know my way around that the same way that I do just your normal everyday stocks. So when looking through some options of ETFs that hold preferred shares, this one seems to be pretty solid. So it does have a pretty high expense ratio of 2.52, and it has 188 holdings, so pretty good diversification there. Now, it was launched in May of 2018, and right now the share price is actually down 15% since then. So I'm not a big fan of that, but again, this is not necessarily about share price appreciation. This is about high yield, and then you can see here we're typically looking at yields ranging anywhere from 8%, possibly as high as 15%. PFFA does pay its dividends monthly, so another nice monthly payer. And if you're looking for something that's going to dependably kick out a pretty high yield month after month, certainly not a bad option to go with. And up to this point, this probably isn't something that you hold in your portfolio, so you could dedicate at least a certain percentage to something like this, so that way you would have a little bit of exposure to preferred shares. Another very popular option in the dividend investing community is JEPI, or JEPI. This is the JP Morgan's S&P 500 covered calls ETF. So this ETF has, as of this recording, about 133 holdings. It's usually around where it is. Expense ratio of 0.35%. It is an interesting ETF because it utilizes holdings within the S&P 500, where the fund managers write covered calls to generate additional income. Since its inception in May of 2020, the share price has actually grown by about 13%, which is one of the goals of this ETF. They do want to accomplish some share price appreciation, and it is a monthly payer that sometimes the yield is going to swing a little bit. It was as high as 13% in 2022. I think 8 to maybe 9%. Give or take is probably what you can expect out of this ETF in most years, but it's still building up a certain amount of history. But there's a lot of covered call ETFs out there right now. I've reviewed quite a few of them, certainly not all of them, but definitely a lot of the more popular ones. And really this one, to me, if I were in the market to buy a covered call ETF to start generating some monthly income, JEPI feels like a pretty safe and consistent one to me anyway. Another one that's a little bit similar to JEPI is DIVO, or DIVO, which is a call writing strategy. And this one has just 33 holdings, a 0.56 expense ratio. The interesting thing about Devo so far is since its inception at the end of 2016, the share price growth is actually 53%. So certainly not bad from a share price appreciation standpoint. The yield isn't going to be quite as high as JEPI, or at least it hasn't been up to this point, but usually right in the about in the 5% range. Some years will be a little higher than others, but another monthly payer. Interesting strategy that seems to be working pretty well so far. So Devo's an interesting one where you're getting some pretty good solid yield, monthly dividend payouts, and you're getting some share price appreciation. So I like that. I like that combination, certainly. So this is an interesting one to maybe take a look at and see if it makes sense for you. And then we have MLPX. So this is an ETF that holds the master limited partnership. So there's 27 holdings, pretty reasonable expense ratio, 0.45. Since inception in August of 2013, the share price growth is only sitting at 11%, but the yield can fluctuate a little bit, as we see back here in 2014. It was just 3.65%. But then if you look at 2020, it got up as high as 10%. So, there's a little bit of swings in the market. MLPs, depending on what's going on in the energy sector, can certainly have their highs and their lows. But the thing about MLP stocks are that not all, but a fair amount of them, if you're buying them individually, you will have to, as part of your taxes every year, you'll get a K1 tax form, which is kind of a pain in the neck. It just adds some complications to your taxes, and it's because of the way that their dividends are distributed. I'm not a tax expert, so I don't want to go into. So I don't want to necessarily stumble over myself here trying to explain it. But let's just say that it's a different kind of dividend. It requires a special tax form that just adds complexity to your taxes at the end of the year. So I like the idea of, if you want some exposure to MLPs, you go with this ETF, and then you don't have to have the K1. You can just, because the ETF does not require it. So you get the exposure to the overall broad market of MLPs, and then you don't have the extra complication of the taxes. So this is a good way to get exposure to kind of an alternative type of stock. Again, because of the tax complications, I don't like to purchase just standalone MLPs. I like to keep things very simple and have nice qualified dividend income. But again, if I'm a current income seeker, I'm nearing retirement age, and I don't have any MLP exposure, very interesting option here to just go with the ETF, get the nice the nice high yield to start out with, and not have to worry about picking and choosing which ones look good versus which ones don't at the time. So that is the video for the immediate income seekers. If you are, in those younger age brackets, I'm not a big fan of any of this stuff if you're under the age of 50, to be quite honest with you. Even if you are a 35, 40-year-old investor and you've just done an amazing job of piling money away into dividend producing stocks, and you're already at the point where you're pretty near retirement, because you still have quite a bit of years left to let your dividend income continue to compound and grow, I'd still be leaning more towards things that have a higher year-to-year dividend growth rate than some of these higher yielding instruments. But again, if I'm at the point now where I'm in my 50s or my 60s and I'm really trying to add just steady, consistent, in a lot of cases monthly paying dividend income, I think these are all some pretty interesting choices that add some additional diversification to just your standard stocks. So thank you for tuning in. I'm Colby, the DGI Crab. Email me your questions at dgicrab@yahoo.com. Check the links in the description below to links to other helpful videos here on the channel. And I hope you all keep investing